Welcome to another RankiaPro Europe interview. Today we are happy to talk to Niall Gallagher, Equity Investment Manager from Jupiter Asset Management, and we will be talking about key lessons from 2025 and prospects for 2026. Thank you so much for being here, Niall. How are you?
I'm very well. Thank you for inviting me.
Thank you so much. Okay, so maybe let's start with a bit of a throwback. How would you describe 2025 for financial markets? And what do you think that European equity investors underestimated this year?
So I think the key, certainly within Europe, was the very significant divergence across different parts of the market. So what we saw was an extraordinary performance in Europe by the banking sector. The banking sector, in many cases, saw stocks double or more. And then on the other side, what we saw was many stocks that we thought were quite expensive, particularly in the quality growth area of the market, derate very significantly. So I think there was a lot of dispersion, a lot of divergence within the market. And the kind of key that we saw was the derating, we think justifiably, by many growth and quality stocks that were too expensive, and then a very strong performance by many of the banks which were undervalued.
Okay, thank you so much. And looking back, what key lessons did 2025 leave for active managers in terms of asset allocation and risk management? How do you feel?
So I think the probably the biggest thing in terms of asset allocation is really on the US side rather than on the European side. But asset allocators who are allocating globally obviously have to think about this. One of the things that strikes us as very interesting in 25, but is still the case right now, is the extraordinary concentration of global equities into the US. So the US share of the global indices is typically 70%. And then within the US market itself, the extraordinary concentration in the S&P 500 of the top 10 stocks. So
Mhm.
typically what we observe is that over 40% of the S&P 500 comes from 10 stocks, and most of those stocks are technology. So we have a very high concentration into a very small number of companies. Those companies are enormous in historical terms, but they're also making enormous amounts of profits in historical terms too. And the profit margins and returns on capital employed of those companies are very, very high. So this is an historically unusual situation where global equity markets really have very high concentration into companies that are making very high levels of profits on very high profit margins and high returns on capital employed. So I think this the key risk factor and the key decision that asset allocators have to make everywhere is whether they're comfortable with that, whether there is too much capital allocated to a market like the US, which has very high concentration in essentially areas that are related to technology. So I would say that is the key asset allocation question. I think it hasn't changed from 25 into 26. And I think it may well carry on for some time longer. But to me, that's the key thing to focus on.
Okay. And focusing on European equities, how did your strategies perform in 2025? And where were you able to add the most value as a stock picker?
So my 25 was obviously unusual in that I spent 1 month, that will be January, in GAM. I then had some time out of the market, and then I re-emerged in Jupiter in May. So if I focus on the period from the 12th of May to the end of the year, which was when I was responsible for the Jupiter funds, we performed broadly in line with the market. So some of our funds were ahead of the market, some were slightly behind. So broadly, I would say we were in line. What worked
Mhm.
particularly well for us was having a very large position in the European banking sector. So in particular, our holdings in Spanish banks, CaixaBank and BBVA, did very well for us, as did our holdings in some of the Italian banks and in Nordea in the Nordic region. So for us, the biggest performance area was banks. And then we had some other stocks that did well, things like Inditex, Ryanair. We managed to avoid many of the expensive quality stocks that did badly. So broadly, that was the areas that were most positive for us. And then we had a few negative areas. So we had a number of consumer staples where we have potentially been a bit early in our acquisition based on, I think, pretty sound investment cases, but we were arguably a bit early.
Okay. Thank you so much. Yeah, I think it was unusual year to many people. And looking ahead to 2026, which major macroeconomic and market trends do you believe will shape global investment decisions?
It's very hard to pinpoint one. There obviously are a number of key structural trends that are important. So the ongoing investment in AI infrastructure, and electrification is a profound trend. There are different views as to whether a bubble is building or not. I don't think we'll know for a number of years because I think the investment in AI hyperscaler capex will carry on for a number of years, irrespective. And the electrification that is required to support that is not just driven by the needs for more electricity for AI data centers, it's also required for the energy transition, which is probably more important in terms of mind share in Europe, but both regions need significant investment in electricity infrastructure. So that's a key structural trend geopolitically. I'd also argue that defense is another one in Europe. So those are, I think, the two from within the equity market that we are focused on. Then I think more broadly, the extent to which inflation is an issue or is not an issue. In Europe, the inflation prints have been quite soft recently. So there is an argument to say that rates may come down in Europe. I'm not so convinced because I think some of the more structural trends are inflationary. And then on the US, there's obviously the actions of the administration, the potential undermining of the authority of the Fed, which will probably not be good for the dollar or for faith in US instruments. So I think there's a broad series of things there. And then obviously, outside of my circle of competence, there is some of the things going on, Russia, Ukraine, and then also Iran, which have the implications and ramifications too.
Okay, thank you so much. And from your perspective as an equity manager, where do you currently see the most attractive opportunities in Europe in terms of sectors and investment styles?
So, given what happened last year with a very strong outperformance by banks and by value, and a very strong underperformance by quality, we think it's time for a more balanced or maybe a more style flexible approach. The very significant undervaluation of European banks has been largely unwound. We still think the banks are on the cheap side of fair value, and we think there are individual banks which have got decent volume trends which are attractive. So I think there is still a case to be made to be allocated to banks, but the easy money has been made. So in 2021 and 22, this sector was screamingly cheap. And that was the time to go very overweight. I think where we are now, it's a bit more nuanced. Similarly, we've had a number of stocks which did very badly last year. Underlying good businesses, good companies, but the shares are too expensive and they've NAV rated. So some of those are interesting to potentially buy. So I'm thinking here of companies like SAP, some of the exchange stocks like Deutsche Börse, London Stock Exchange Group, I think are interesting. And then
Mhm.
potentially other companies like L'Oreal are looking more interesting too. So that's kind of within where we are in Europe. In terms of standout stocks that are very cheap, it's hard to think of any big dislocations within the market. So we don't observe any particular sectors that are standout cheap. There obviously are some areas where there are some interesting structural changes going on. So one of the ones that's interesting is steel. So Europe has applied the carbon border adjustment mechanism for the first time. That could
Mhm.
lead to some quite significant falls in steel imports, which will obviously be very good for domestic European manufacturers. We've seen some pretty strong appreciation of the copper price. Whether that carries on going, I mean, reverts, has implications for mining. And then just more broadly, we have a number of longer term structural trends in the portfolio, which we will continue to invest behind. So electrification would be one, semiconductor capex will be another. Some of these stocks have done well. They're not necessarily the cheapest stocks, but the underlying growth fundamentals for the next couple of years are good. And then, as always, outside of trends and themes, there are individual companies that do their own thing that are interesting from a idiosyncratic perspective. And it's here we often find some of our most interesting ideas.
So thank you so much, Niall, and thank you to everyone watching us. Don't forget to subscribe.
Thank you.